Welcome back to my channel. It's me again, friends, and on this vlog, we will discuss about economic indicators. Economic indicators are reports that detail a country's economic performance in a specific area. These reports are usually published periodically by governmental agencies or private organizations, and they often have a considerable effect on stocks, fixed income, and foreign market when they are released. They can also be very useful for investors to judge how economic conditions will move markets and to guide investments decision. The following are some of the major economic reports and indicators used for a fundamental analysis. First is Gross Domestic Product or GDP. The GDP is considered by many to be broadest measure of a country's economic performance. It represents the total market value of all finished goods and services produced inside of the country in a given period. Many investors, analysts, and traders don't actually focus on the final annual GDP report, but rather on the two reports issued few months before the advanced GDP report and the preliminary report. This is because the final GDP figure is frequently considered a lagging indicator, meaning it can confirm a trend but it cannot predict a trend. In comparison to the stock market, the GDP report is somewhat similar to the income statement a public company reports at year-end. Another indicator is the retail sales. The retail sales report is very closely watched and measured to the total receipt or money value of all merchandise sold in stores. The report estimates the total merchandise sold by taking sample data from retailers across the country, a figure that serves as a proximity of consumer spending level. Because consumer spending represents more than 2/3 of GDP, this report is very useful to gauge the economy's general direction. Also, because the report's data is based on the previous month's sales, it is timely indicator. The content in the retail sales report can cause above normal volatility in the market, and information on the report can also be used to gauge inflationary pressures that affect rates or prices. Another indicator is the industrial production. The industrial production report reports on the changes in the production of factories, mining, and utilities in the country. One of the closely watched measures included in this report is the capacity utilization ratio, which estimates the portion of the productive capacity that is being used rather than standing idle in the economy. It is preferable for a country to see increasing values of production and capacity utilization at high levels. Typically, capacity utilization in the range of 82 to 85% is considered tight and can increase the likelihood of price increase or supply shortage in the near term. Below 80% are usually interpreted as showing slack in the economy, which might increase the likelihood of recession, which is bad for the country and its people. Another indicator is the employment data. The Department of Labor and Employment releases employment data report. Generally, sharp increase in employment indicate prosperous economic growth. Likewise, potential contractions may be imminent if significant decrease occur. While these are general trends, it is important to consider the current position of the economy of a certain country. For example, strong employment data could cause a currency to appreciate if the country has recently been through economic troubles, because the growth could be a sign of economic health and recovery. Conversely, in an overheated economy, high employment can also lead to inflation, which in this situation could move the currency downward. Another indicator is the CPI or Consumer Price Index. This measures the level of retail price changes. the cost that consumers pay, and is the benchmark for measuring inflation. Using a basket that is representative of the goods and services in the economy, the CPI compares the price changes month after month and year after year. This report is one of more important economic indicators variable, and it is released can increase volatility, equity, fixed income, and foreign exchange market. Greater than expected price increase are considered a sign of inflation, which will likely cause the underlying currency to depreciate. And that's our vlog for the different economic indicators. I hope you learned something. Until next vlog, keep safe always.